I think it's economics 101 in high school. You can't just keep pushing out money. You can't just keep giving away money and giving away money, because that money will definitely lose its worth.
Woo! Baby, it looks like we're heading into what is a full-blown bear market by a self-fulfilled prophecy of every investor cramming it down your throat, making you question your own psychology of, oh my God, everyone's going cash, everyone's going gold, I need to be shitting my pants here, making you re-question your investing philosophies. As I'm guessing, you got slapped upside the head if you've only been in this market for 2 years, and maybe you've never experienced a bear market like I have. And I want to talk about my strategy today, general strategies, because most of you attest to that idea of cost average investing in global market index funds, the S&P 500 index, because historically over a 20-year time period, you would have outperformed that person selling the tops, trying to buy the bottoms, those people that lump sum invest, because everybody knows the cost average investing lifestyle generally works and kind of puts aside the insanity and these ups and downs of these cyclical cycles here, right? But a lot of you have been calling me out recently saying, hey, Kyle, you going cash. Why are you going cash? That's not cost averaging. Why are you doing all this stuff but telling people to do other things? Because this is entertainment value, baby. And I make money off making YouTube videos, and I love playing the markets because historically over the last several years, I have drastically outperformed by swing trading and getting involved in small caps, risky companies, building out a nice solid dividend portfolio. And I want to talk all about my strategy today, how I plan on kind of playing this out, because a lot of you said, hey, Kyle, when are you going to start putting cash in the markets? You got to tell us when you're going to start investing. And obviously in the clarity of my transparency, I always will show you what my portfolio and what I'm doing every single week here, guys. But I want to know what your strategy is, because I've been hearing some crazy stuff lately, like people going 20% cash, waiting to kind of reallocate some capital when they feel comfortable in these markets. So let me know what your strategy is in that comment section below. I'd love to hear about it. And while you're down there, hey, do me a favor. Hit that like button, folks, because let's get right into this with first and foremost, what's really scaring the crap out of investors is the idea of value investing. Most people would have attested to this idea, and we get it from Warren Buffett and now famously Everything Money. And if you've been buying the stocks they have been telling you are great value investments, you've been getting probably more slaughter than even just buying some growth stocks like Tesla. I mean, let's be real here, because Facebook, a favorite of mine, now at a PE of 14. And if it was such a great value play, which I think it is here, why is it still dropping? Alibaba, great example. Intel, oh my God, guys, these companies are cheap. The PEs are absurd. Why are they continuing to go down? Dare I say, look at Home Depot. Crushed earnings, great revenue guidance, and damn, it is still selling off like a knife. And even on the Canadian side of the border, these tech companies, Shopify, just absolutely slaughtered here, folks. So how do I feel about this? Well, this proves the idea that fundamentals aren't the only thing at play in the markets. And I've talked about this many of times, guys. You can be a value investor, but most of you should realistically just be ETF investors, because you don't understand sometimes why this happens. And this is great. This is the opportunities that are going to make you rich. It's just a matter of how you feel comfortable taking advantage of them. And let me talk about how I've been kind of building up to what I'm doing here by taking a look at the broader markets, because this was a pretty insane day, guys. This day hit us very hard from the geopolitical tensions, the hyperinflation fear, but we're getting to a point where that fear is getting so exacerbated that it's pushing us down into a market where there's going to be better value than there's ever been. And it's extremely healthy for newer investors, because historically, I am a bull in the market. I continue to be a bull, and 3 to 5 years from now, this conversation will be mute. But speaking about my stocks that I love, the only thing keeping my portfolio at bay is RioCan. And I just want to shout out the Rio clan out there, because this thing has been pumping returns week over week. My largest holding, and it is in the Canadian real estate sector. But many of you know I have been selling tech stocks down. I haven't got rid of them, but I have sold down at Apple, Microsoft, Tesla, Facebook. I have repivoted my volatility risk to try and put it where I think I'm going to outperform. And that has been with banks. That has been in a lot of the Canadian sectors like the telecoms. And that has boded very well. And some of those positions I just took into cash. And speaking about that cash, most of those companies, including Tesla, are now well below where I've sold out of them at. So my strategy thus far, gambling, speculating, don't do what I'm doing here, is working in my favor. Doesn't mean it's going to continue to. And a lot of you said, well, when are you going to invest that cash? Because I want to be like Warren Buffett. I want an elephant gun. When I see the deals that I want to take, I want to be able to take them at a higher percentage rate of investing than I can typically do for my working capital. Because most people, like I've said, guys, if you've got 20 grand in the market, you're making 60,000 a year, you're able to invest 15 or 20% of your income. I mean, mean, you're going to be able to double your portfolio just by putting money away. That's not going to happen with me. My portfolio is at scale. There's no way that me just investing the same amount every month will make a large material difference. So I want to try and make a larger material difference by increasing the amount that I'm going to be able to invest month over month when I start feeling like the opportunity is starting to exist. And right now, that is not by catching a falling knife. I've said this with BABA. I've said this with a lot of companies out there. I want to make sure that the fear is behind us. People are recognizing them as value, and the psychology of the market starts to shift. But primarily where a lot of my attention still sits is in index funds. I have a large amount of capital waiting to dive down into my favorite dividend companies. And right now, all of my favorite dividend companies sit in an ETF called VYM, which I said I made a bet that it's going to outperform the VOO because historically in these times, people look to value to dividends, and that's where the money's kind of flooding. So we're not seeing VYM get hit hard as the S&P 500 index. But nonetheless, guys, I really want to see VYM pop over a 3% yield, and I'm hoping we're going to get there. So I've left some room to buy some shares there. And just taking a look at the holdings and why I like this so much, these are all my favorite U.S. dividend stocks: Johnson & Johnson, J.P. Morgan, Home Depot, Procter & Gamble, Bank of America, ExxonMobil, Pfizer, Chevron, AbbVie, Pepsi, Coca-Cola. This damn near looks like PPC Ian's portfolio, dare I say. Verizon, Wells Fargo, Intel, all these great companies we've been talking about. AT&T, McDonald's, another favorite of mine. So instead of me trying to pick these at the bottoms and not really know like when I should add that one, oh no, I can't buy enough of this one because I don't have enough capital anymore. Oh, I'm just going to be buying 50 stocks. It's just so much easier to buy this guy. So I want to see this get into a juicier yield, and I'm going to be buying a huge chunk of that. I've also made room to obviously add things like Pfizer, trying to add more healthcare to my portfolio for the long term, and I want to see Pfizer down in the $35 to $45 range, and I started a position. I said I wanted to see it go lower, so I'm leaving some room, and dare I say, that's what's happening right now. So fingers crossed, my speculations in the market are paying off, and this is absolutely beautiful. Now, a lot of you are like, well, there's a lot of value according to Jeremy in the small cap sector, and the thing is I have my growth positions built out, guys. The vast majority of my growth positions will always be in large caps, with the odd exception now and again of small caps that I get intrigued by. In history, in my investing career, obviously MindMed, Canopy, a lot of those other companies that I won't touch, like in the EV field, so I kind of stick to Tesla. But honestly, this is a great opportunity for people looking to build out a spec part of their portfolio. For me, I like large cap spec. I got my love with Tesla, and like I said, I'm very careful with how I mitigate that capital. But Tom Nash posted this on Twitter showing all of these incredible small cap companies. A lot of these are great small caps, and they are devastated, down 60 to 90% from their highs here, guys. So these could be places and opportunities for you to start looking perhaps. But where I see the most opportunity coming up in the next 3 to 6 months when I start planning on using my elephant gun, as Warren Buffett calls it, right, guys? I think this is a strategy that would work for a lot of people. You should always have an emergency fund, but I think you should have a portfolio emergency fund. And what that means is when the market goes into bear territory, which if you're investing for 20 years, which I hope you're going to be, this won't be the only bear market you're going to experience. And we don't even know how bad this bear market's going to get. But the idea is to be able to invest more money and take better opportunities of cost average investing when we see better deals in the market. Most people would just shovel every dime they have left over at the end of their working month into the market and not think about it. But wouldn't it be a little bit better if to have an emergency cash fund so you can increase the percentage of buying at the end of every month, allocate a little bit more when things look a little juicier? Because most people don't have that opportunity right now. I do, and I plan on taking advantage of it with that elephant gun because I don't think Apple and Microsoft are going to hold up. This is a real speculative bet here, guys, but when every single growth company and dare I say value company that is posting the best earnings possible in this current market are still able to drop 10, 20, 30%, the only thing holding up the markets right now are large caps like Apple and Microsoft, largely controlled by hedge funds and index funds, guys. And if people's hands even slightly shake, we are going to go into a full-blown bear market at the snap of a finger, and I'm speculating that these stocks could severely sell off coming into Q1. We're going to get the interest rate news. Apple's going to have no choice but to post guidance. And even though they could post great numbers, if that revenue, in my opinion, is even off by a little bit, just a snitching amount, it's going to drop just like everything else has. So I don't want to be overly exposed to these companies because that's what I'm speculating on. So that's why I sold Apple. That's why I sold Microsoft down slightly. And I might even buy back into them when I think the opportunity arises. But take a look at this. Historically, Apple over and over again over a 5-year period, typically 3 or 4 times, will drop 30%. So it's not a surprise that when everything else is doing that, that Apple is any exception to that rule. So again, guys, don't do what I'm doing here. I am playing a game that should be taken as entertainment value, and whether it works out or bites me in the ass is purely up to your entertainment. We'll see how it unfolds here, and I will surely let you know when I start investing bigger amounts of capital here. I'm just trying to protect my downside risk, and everything I've done so far by shifting my sale has been voting into my favor. Now, I'm not a genius. There's nothing that makes me smarter than a guy that has a full economic degree here, but hey, it works for me, and what works for me is going to keep happening, and well, maybe it won't keep happening, but I'm gonna keep doing it, damn it. And like I said, if you want to see how that unfolds, I highly recommend subscribing, but I will always tell 99% of people to cost average into the market. Be very mitigated with your individual stocks. Most people do 50% index funds, maybe a few percentages of growth, you know, some of those individual holdings, but again, pure entertainment value here, guys. Let me know what you're doing. I'd love to hear about it, and remember, be excited. This is where people get rich.